Volatility has been a key feature of markets in 2022, and it moved to a whole new level last week with the invasion of Ukraine. So how are markets faring now that sanctions have been put in place, and what should investors be aware of? We're here today with James Buckley, Senior Equity Research Analyst, and Phil Byrne, Deputy Chief Investment Officer and Head of Equity Investments at Merrion Investment Managers, to run through some of those quick questions. Phil, thank you for joining. Perhaps you could just set the scene in terms of what's been going when the world changed 5 or so days ago.
Hi, Alan. Yeah, it's certainly been a volatile year to date. And what we've seen in the last 5 or 6 days is a complete reversal of all the trends that we'd seen year to date. Before the invasion of Ukraine occurred, the best performing assets were cyclical stocks, value stocks, European stocks, emerging markets. Bonds materially underperformed, US equities underperformed, quality US equities underperformed. That all changed, not only when the invasion occurred, but when we got what was some of the most comprehensive sanctions we've ever seen on a country. Subsequent to that now, you're seeing a full reversal in the last 3 or 4 days. European banks, European energy companies, and the European market itself has fallen double digits, whereas the likes of the US equity market and US bonds are starting to rally quite substantially.
And James, how has that impacted portfolios generally, and how have we been buffered from the recent volatility?
I think it's no surprise that investors have gone to what they regard as safe havens, and within the equity space, that does tend to mean US and quality growth and tech and so on, because their earnings streams are viewed as being more resilient to the potential economic fallout from the Russian invasion of Ukraine. So, within our research, we do cover a number of the large cap tech names, the Apples, the Microsofts, and other names that have proven to be really where investors have rotated back into, certainly over the past week, and we would continue to see that trend intact in the very near term at least.
So do you see this as an opportunity, notwithstanding the obvious fluid environment that we're all investing in, more so an opportunity than a situation where we need to start trimming exposure, raising cash levels, etc.? And where do you see greater opportunity?
Well, we see from now, you'll see a complete bifurcation of returns across global asset markets. Europe, unfortunately, is suffering from a number of different angles, whether it's the war itself, the sanctions that have been imposed on it, a mini commodity crisis, an emerging market financial crisis given the pressures in Europe. Given the pressures on the Russian economy. On the flip side, however, the US, which is relatively insulated from the conflict, will actually benefit from the severe repricing we're now seeing in regards to what the central bank in the US is going to do. About 2 weeks ago, people were trying to price in 7 rate hikes in the US this year. At the moment, that's already down to 4, and it looks like it's going to fall further. What's particularly interesting is at this point in time is, as I said, the invasion occurred when we'd already had quite a strange year to date, where European banks say we're up 10% versus the Nasdaq down 20%, and that still hasn't. That divergence in performance is only starting to narrow now. So even today, as we speak, European equities have outperformed US equities. So we think you're going to see a large amount of switching out of what has outperformed year to date into what's underperformed year to date. And as James said, ironically, what has underperformed year to date are the safe havens. Bonds, even, for example, at one of their worst starts to the year, they were down 5 or 6% on the year. They're now starting to rally materially. Similarly, the dollar as well is starting to outperform. Gold is starting to outperform as well.
Okay, so obviously the benefits of a broad-based portfolio really kick in this environment when there are obvious winners and losers. Could I ask both of you maybe to jump in terms of where you see this playing out, if it's a short-term conflict or a medium to longer-term conflict, i.e. months and possibly further beyond? How does that play out for markets? Very, very generally.
I think there was some, I read some research over the weekend from Oxford Economics who were basically saying that, Russia and Ukraine together are 2% of global GDP. Their predictions at the moment are for global GDP to be impacted by less than half of 1%. Now that is predicated probably on a relatively swift ending to the conflict. And that may have already been overtaken by events with what we've seen in commodity prices rising and the stronger sanctions coming out of the European Union. So I think what markets will be driven by is the impact on the global economy, and it's really just too early to say that for sure. But does go back to those safer haven stocks, that balanced portfolio that you've conviction in.
Yeah, we think as well, the way we're looking at it is that hopefully the violence might subside in the short term, and we could get a cessation of the atrocities we're seeing. Unfortunately, the long-term implications for this are only starting, and they're not going to go away. We've seen on the last weeks Germany throwing out 40 years of foreign policy and 40 years of energy policy. They've announced they're going to spend 100 billion euro on defense. They're weaning themselves off all Russian gas. They have stopped shutting down their nuclear plants. BP and Shell overnight have effectively written off all their investments in Russia. The economic consequences and the political consequences are going to last for years and years. And we think the risk premium that investors, particularly US investors, put on investing in Europe and in emerging markets is only going to ratchet up. So hopefully in the short term, we get a cessation of the violence, but the long-term implications of this are only starting. And I think that it's difficult to work out exactly just how far they'll reach. Obviously, there's industries close to home like us, like aircraft leasing, be facing an uncertain time at the moment. We don't know if Russia retaliates. So, if Russia retaliates and cuts off gas fully to Europe, we don't know the implications of that. So we just feel economically, it's going to last a long time.
Okay, so to sum up, James, perhaps you could propose, what do you propose clients of Cantor do?
Well, historically, it has paid to remain optimistic on equities, even in these very difficult times. I guess every situation is different, but if we think back to 2003 with the invasion of Iraq, the market did dip, it did pull back, and then went on to reach new highs. So I think stay focused, stay in touch with your Cantor broker, keep reviewing the situation, but I wouldn't be a seller of equities at the moment.
Thanks. And Phil, finally, how have you guys in Merrion been positioned coming into this, and has it changed your strategy going forward?
Yeah, it has. We have been very busy in the last few days, particularly in the immediate aftermath of the invasion and just ahead of the sanctions that were going to be announced. We felt that was a good time to materially reduce all exposure to Europe and emerging markets, and to put that money into the US. Also, we rotated a lot of cash out of our defensive funds into some long bond funds, which we think can actually offer some good capital appreciation over the months during these uncertain times.
Thank you for tuning in. If you have any questions, please contact your Cantor Fitzgerald broker or portfolio manager.